She sold her tech company for millions, but stocks and real estate aren't enough. Find out how this Silicon Valley entrepreneur is diving into the risky world of venture capital and private equity with her $100 million portfolio. Is the only way to grow your money by risking it all? When you have a lot of money, like $100 million, you want to make sure it keeps growing, but also that you don't lose it all. That's where diversification comes in. It means not putting all your eggs in one basket. Instead of only investing in tech stocks or real estate, you spread your money across different types of investments. This way, if one investment does poorly, the others can help make up for it. At the heart of diversification is asset allocation. This is how you decide to divide your money among different asset classes. The main ones are equities, stocks, bonds, fixed income, real estate, commodities like gold and oil, and alternative investments like private equity or hedge funds. Think about Sarah, the tech entrepreneur. She might want a portfolio that focuses on growth, so she might put a larger percentage of her money into stocks and venture capital, even though those can be riskier. Then there's David, the retired CEO. He probably wants a steadier income, so he might prefer bonds and dividend-paying stocks. Maria, from Sao Paulo, might want to invest in a socially responsible way, so ESG, environmental, social, and governance investments would be important for her. And Kenji, the Japanese businessman, might seek global opportunities, including real estate and private equity in the US, while being aware of global financial policies. Equities or stocks represent ownership in companies. They can grow a lot, but they can also be volatile. Bonds are like loans to governments or companies. They're generally less risky than stocks, and they provide a steady income stream. Real estate can provide rental income and appreciate in value, but it can also be difficult to sell quickly if you need the money. Commodities are raw materials. They can be a good hedge against inflation, but their prices can be unpredictable. Alternative investments are things like private equity, hedge funds, and infrastructure. They can offer higher returns, but they're also less liquid and more complex. Diversification also helps with risk management. There are many types of risks, such as market risk, the risk that the overall market will decline, inflation risk, the risk that inflation will erode your purchasing power, and interest rate risk, the risk that rising interest rates will lower the value of your bonds. By diversifying, you can reduce your exposure to any one of these risks. There are two main approaches to asset allocation: strategic and tactical. Strategic allocation is a long-term approach that's based on your goals and risk tolerance. Tactical allocation is a short-term approach that involves making adjustments to your portfolio based on market conditions. It's also important to rebalance your portfolio regularly. Over time, some of your investments will do better than others, and your asset allocation will drift away from your target. Rebalancing means selling some of the investments that have done well and buying more of the investments that have lagged behind to bring your portfolio back into balance. Finally, don't forget about tax implications and estate planning. You may want to consult with a financial advisor to develop a tax-efficient investment strategy and to plan for the transfer of your wealth to future generations. We've touched on many aspects of diversifying a $100 million portfolio, but there are still some areas we haven't fully explored. For example, how do geopolitical risks affect asset allocation decisions? What are the best ways to incorporate impact investing into a large portfolio? And how does one navigate the complexities of international tax laws when investing globally? If you found this video helpful, please like, share, and subscribe to our channel for more insights on wealth management and investment strategies.